There we go. We are live. So this is For Investors by Investors Long Beach, and my name is Matthew Owens. Tonight we are talking about self-directed retirement accounts. I am a CPA and a full-time real estate investor, and I flip about 5 to 10 houses a month right now out of state. I've been doing it for about 10 years. We've flipped over 600 houses. We also do a lot of value-add multifamilies. We lend capital out to other flippers. We have a short-term rental business. We raise capital for different syndicated investments and things like that. And then we run this group, this nonprofit organization, where we teach financial education and real estate education without a sales pitch involved. And we bring in high-quality speakers like Karin here, the owner of UDirect IRA Services, and she's a wealth of knowledge. We've done a ton of different classes and webinars together, and probably one of the top experts in the field when it comes to self-directed retirement accounts. And I have to say, her knowledge base, and I got to give her thanks for the amount of knowledge she's bestowed on me over the years on this and staying up on the industry and things, the changes in the industry. Karin, could you tell us a little bit about your background and how you got started in self-directed IRAs?
So
or retirement accounts?
You want me to go or no?
Yeah.
Okay. We will speed it up a little. Okay. So I guess I was a radio announcer for 17 years. So that's what I did. And so then let me do it?
Yes.
Yeah, there you go.
Oh, yeah.
Light rock, let's talk.
I love it.
And then I made the logical transition into real estate, right? Don't we all? And then did a little bit, I was a realtor, property manager, got into mortgage loan servicing for 8 years, then got into mortgage loan origination, and then of course, as we all know, the bottom fell out of the mortgage market, and I was looking for a job, and I got a job at a self-directed IRA company, and I did that for a couple of years and did pretty well, and I thought, well, I'll just do this myself, so I did. So with Matt's help, Matt was there with me day one, we're buddies and hanging out, and so that was 2009, like September 1st, around 2009. It's been like almost 9 years.
Wow, that's a long time. Awesome.
Crazy. And so in that time, the company's really grown, and I sit on the board of directors for the Retirement Industry Trust Association. We just had our meeting in Washington, D.C. Just got back from it last night, which is great because you guys will hear all the fresh information. Not a lot changes in our industry from year to year, but a couple things to talk about. So that takes me through my career.
Great. And right now with UDirect IRA Services, how do you help clients? Can you talk about what a self-directed IRA is and
Sure.
and how it works compared to other IRAs and 401ks?
Right. There's so much misunderstanding about what a self-directed IRA is, and it's not just from investors, but it's from people who are like bankers and CPAs, attorneys. A lot of people misunderstand what this is. Regulators misunderstand what a self-directed IRA is. So an IRA is an IRA. It's a way to save for retirement. It's an individual retirement arrangement. Gerald Ford signed the ERISA laws into effect in '74. They went into effect in '75. So that's 43 years. I mean, longer than some of you have even been alive, right? So it's been a long time. They've been around a long time. So that's what it is. A self-directed IRA lets you invest in what's called alternative assets, which is not the stock market, so non-correlated assets. So just know an IRA is an IRA. A self-directed IRA, they're just buckets that you're going to put assets in. That's what IRAs are. And in a self-directed IRA, you can invest outside the stock market into alternative assets, they're called, like notes, like real estate. You can wholesale. You can do fix and flip, multi-family, raw land, whatever you want.
Okay, great. And from my perspective, I've used the self-directed IRA or 401k or self-directed retirement accounts in a number of ways for myself. And so a lot of the things that people utilize them for are, one, tax mitigation, right? Going through and contributing as much as you can to these things to mitigate your current tax situation, which is huge. But then at the same time, also being able to utilize it for your own investing, to create your own cash flow streams, but also utilize other people's retirement accounts for your own investing and utilizing it as a tool to be able to make them a return and yourself a tool once you understand how to protect those investors. If you don't understand how to protect those investors and how the IRAs work in the first place, you're going to get yourself into trouble by doing the wrong things and possibly losing your investors' capital. And that's the worst thing you can do because...
Which is at the same time. That number was about to 4 trillion, and so it's really increased.
So there's
As a
3 to
lot of
4
people have left
trillion,
their jobs, yeah.
$3 to $4 trillion inside
Then,
IRAs. Oh,
that
then.
was then. Now it's 8.9.
Oh, wow, that's
Yeah.
amazing. So this is untapped money, and I can tell you that 90% of the people out there do not know what to do with their money. Okay, so if you become a specialist at understanding what to do and how to protect their money, you can kill it. You can just absolutely kill it. But you have to, have that respect for that money first, of course. And so, speaking of that, a lot of people try to go into IRAs and retirement accounts, but don't have time. Don't have that experience and knowing what to do with their money because they've been in the check the box. I want risky, mid risk, or low risk type mentality with a traditional company like Fidelity or something like that. And all of a sudden, now they're responsible for their own investments.
It's not a check the box kind of thing.
Right. This is something you're active in. Can you talk about a little bit about some of the intricacies about how a normal IRA works and how someone goes about investing their money into a investment in the first place inside of an IRA?
Right, and I will, and I'll just say, when you've got a financial advisor and they've got a license like a Series 63 or a 7 or something, they're going to hold your hand the whole way through. Then they're going to get paid on your assets under management, and they're licensed to sell you securities, stock market. A great conversation to have. But once we can maybe talk about it later, a little more in depth. But the way you get an asset into a self-directed IRA, really it's a 3-step process. You open an account by filling out some paperwork. You fund the account either by making a contribution where you check with your CPA and you say, hey, how much can I contribute? It'll be based on your income and your age and also your account type, but you find out how much you can contribute. You could do an IRA to IRA transfer where you maybe it's just another IRA somewhere. I mean, you would use our paperwork, fill it out, or you can do a rollover. You said you have a lot of 401ks, so that's called a rollover. So you don't come to us and fill out our paperwork. You go to your plan administrator, fill out their paperwork after you've opened an account, and they'll roll over that money into an IRA. So if it's like a 457, a 403B, 401k, an employer plan, you put money in, you invest. So you choose your asset, and the way you choose your asset is by just being here. How many different asset classes did we hear about? Just mentioned right here, like notes, for example. Notes are real popular, and so say whatever you want to, you choose something like that, and then you found the asset, you decided what you want to do, you made that decision. So then you give us a direction letter, which tells us, it's sort of like a check where it's got your name and how much, and you sign it. You give us the supporting documentation, which is maybe if it's a note or deed of trust, maybe it's an offer to purchase, maybe it's a private placement memorandum, could be a lot of different things. You give us that supporting documentation, we review it, fund it, and then all the proceeds go back in the IRA. If there are any expenses associated with that asset, they're paid for by the IRA.
Okay, great.
In a nutshell.
So bi-direction letter to say, hey, fund my money here, legal paperwork that goes with it.
Right.
And then you say, okay, great, invest. All the paperwork is, as long as that paperwork is put together correctly,
Right.
and so in the beginning, I didn't know what I was doing, and we're submitting paperwork wrong and things like that. And every time a custodian comes back, you're like, hey, I gotta make sure I get my stuff right, which is great. Now, don't get me wrong, IRA custodians don't have a fiduciary responsibility necessarily here at all with regard to your paperwork or your legal documentation, or even helping you to tell you if it's a risky or not risky investment. They are not here for that. They are here right back into your IRA tax-free. So any investment that you have, all the income comes back into your IRA, or tax-deferred, or if it's a Roth, tax-free in the long term. So what typical documentation do you normally see come with a promissory note when it gets submitted to you? What's the typical? I'm not saying what is legally right here, guys. This is not an attorney question here, but yeah.
It's funny that you're talking about this because, I said I just came back from the conference and we had this really, for us, funny conversation about the kinds of notes that we see. Napkin notes that are written down and they don't have any a term or the things that people want to self-direct. So understand that yes, you get to invest in the assets that you know, but the administrator, the custodian or administrator gets to say what's administratively feasible, like what we will and won't take.
Right.
So some notes that we won't take, we want to see that a note has a principal amount and interest. Amount of interest, and you can't change like 4 different kinds of interest. It has to be understandable. So principal, interest, a duration, a maturity date, these basic elements of a note, and a lot of times we'll get notes and it doesn't have any of those things. So you have to go back and make it has to have all the elements of a note. And if it's secured, we need to see the security instrument.
Okay. The note governs the document or governs the actual contract involved, and then you have the deed of trust, which secures your money against that property. You can also have some other things like an assignment of rents and leases, which gets recorded so that you can actually go and collect rents directly if you don't get paid. There's a lot of different documentation that goes into just a promissory note. Now, you can also buy houses inside your retirement account, right? So how does that typically work?
Well, it's the same process, but when you're buying a house, using a self-directed IRA, I think one of the things you need to remember is, say for example, you're partnering with somebody on the house, because a lot of times your IRA won't have 100% of the home value. So if there's, say, 2 people investing, that whatever your pro rata split is, it starts from the beginning. It starts from the earnest money, it goes on to closing costs, and then now you've closed, now you need a new roof, so then you each pay your pro rata share of whatever happens. And similarly, you get the pro rata share of rent back, and it's always split pro rata like that. So when you've got a situation where you're partnering with somebody with your IRA, that means your renters have to literally write 2 checks, one to you and one to the other investment partner. And that can get cumbersome. So having a property manager can be very helpful, because you're welcome. I always say that, but it's a good shameless plug for you. But the reason that you want a property manager is because then your tenants can just write 1 check to the property manager. They can withhold your self-directed IRA can borrow money, yes, but I come from the lending background and mortgage and residential lending, so I was really surprised when I found out a lender would make a loan to an IRA account. It's not to you, the person. It's not about your FICO score. It's not about how much money you have in savings or how long you've worked at your job. It's about the property. It's about its location and condition, but it's mostly about the rental income. So a lot of times these non-recourse lenders, I want to see a rental agreement before you close. They want to see the cash flow. And with a lot of these non-recourse lenders, they want you to have more skin in the game. So it's not going to be like a 5% down or anything like this. It'll be where your IRA will come up with 50, 60%, and then the loan will cover the rest. So that's typical. But then it goes down to the next levels. When your IRA receives income because of borrowed money, the money you receive because of borrowed money is taxable. So, Matt can elaborate on this, but it's called UDFI, Unrelated Debt Financed Income Tax. Doesn't mean it has to kill your deal. I mean, the rate's pretty high. It's the same as a trust rate, which I think got lowered to 38%, something like that. Or
Lowered to that?
Yeah,
Lowered to 38%?
Yeah, exactly. So it can be pretty hefty, but check with your tax advisor, and always begin with the end in mind. Pencil things out, like here are my acquisition costs, my closing costs. I'm going to borrow 30%, so I'm going to get a $1,000 rent check, so every month $300 is going to be taxable, and so that's going to be this rate. You're going to factor everything out before you even enter the deal, and do your homework so you can say, hey, is this a great deal? Because
when you actually borrow funds inside of a 401k versus an IRA, you don't have that UDFI tax,
that's right.
Which
401k,
is
solo 401k,
really interesting.
Did you say you have one? Your solo 401k does not pay UDFI tax.
Yeah, which is really interesting. So just to give you guys an example of a deal that I did, inside my 401k, I did a $500,000 loan on a property in North Carolina at 12% and a point, and then and that was at 65% of the value of that property, and then I borrowed $450,000 of it at an 8% rate, and that was at 51% of the value of the property, and I was able to go through and make on my $50,000, I'm making like a 34% return on my money. And so it's a fully cash flow asset in there so they can live off of those things. So think about these types of things as you're investing in real estate in different ways, how you could utilize the self-directed IRAs to make money, but at the same time provide a really good product to different people. And do I care that it's non-recourse? Because I can't go after that IRA owner. They can't legally qualify and be on the hook for these loans. It has to be non-recourse for them. And so I'm looking at the property only, which is why most of these lenders make you put down 40% or more or something like that on the deals, because they can't go after you for any deficiency. They want to make sure that there's enough skin in the game to make that type of deal work, because they're looking at it as an asset-based loan only for their protection. So that's really, really key when you guys are investing. They're great strategies for self-directed retirement accounts. It's a very, very big thing that you can do to really supercharge those things. And if you can get it into a self-directed Roth 401k or something like that, it can be absolutely amazing. Let's talk about some of the due diligence and things like that some of the people you see doing on these deals. So like on a house, based on what you're seeing, I know you're not telling people how to do the due diligence on this, but what are some of the things you see people doing on the due diligence side when they're trying to buy a house
I think the
for their IRA?
basics, we see people, doing a title report, making sure the seller can actually has the right to sell the house. That's good. And checking out the terms, but also checking out the condition of the house, getting inspectors and things like that. And the IRA would pay that expense.
So everything you normally do when you're trying to buy a house, you want to do this. So keep in mind, guys, you're not checking the box anymore. You're actually going through and doing the homework on those deals. Making sure when you invest in a house that it has the good bones, it has the good systems, you're not going to lose your money. Because what happens if you run out of money in your IRA? What do you have to do in order to do that?
If your IRA runs out of money, because all expenses have to be paid for by the IRA, there are 6 things you can do. You can make a contribution to make up for the shortfall. You can sell another asset in your self-directed IRA and then use that cash to make up for it, or transfer money from another account and bring it in. You could partner with
fund taxes that go into an IRA.
Said the CPA.
Yeah. The unrelated debt, or no, that's the debt one. The business one. The UBIT. There we go. Unrelated business income tax. So what is that, and how do you what kind of I guess,
like, when does it show up?
When does it show up? When does it matter?
Right. It's when your IRA invests in an active business. So when I first started in this industry, there were a lot of homes to flip, and so there are a lot of flippers in the audience. And if your IRA can flip, that's fine, and buy a house, fix it up, and sell it. But then it can also be viewed as running an active business. So if you're a professional flipper, and that's how you make your income outside the IRA, and you flip even one property, it might be, I should say, subject to UBIT tax. But with the IRS, it depends. But typically, as long as your IRA is for investment purposes only, and you're not running a business in the IRA, you flip, like what they say, 3 a year, but the IRS doesn't give us a number.
Right. This is just different attorneys and CPAs saying, look, this is what the guidance we've gotten over time, and it's not set in stone. Every IRS agent could be different. So.
And there's one young woman who was going to appeal something because the IRS said that she flipped something like, 25 houses in her IRA in 1 year. Like, good for her, right?
Wow.
And they said she's a flipper, and that was her job, and so she owed this UBIT tax. But she was claiming that she didn't, so she appealed it. And they said that 7 of the houses, she only had to pay UBIT tax in 7 of the houses, and the other 18 went tax-free.
What?
Why? It depends. It's because that was the judgment that they made. So had to do with the people she was talking to and so forth. So anyway, the IRS doesn't give us a lot of guidance on how many houses you can flip. But another time, I was speaking last week, and somebody came up to me and says, I invested in a private placement, and you didn't tell me that that I was going to owe UBIT tax. It's like, well, okay. So we need to do.
If you make your account one of those checkbook, self-directed IRAs, does that automatically say that it's a business and then that you may trigger the UBIT? Or
No, not at all. So let's talk about the IRA-owned LLC. So
Absolutely.
It's called a checkbook IRA, which is a terrible name because there's nothing, like the IRS doesn't have a checkbook IRA. It's not in the IRS tax code at all. It's just like a jargon kind of a name. But it really is an IRA-owned LLC. So it was Swanson v. Commissioner in 1996. It started all this. But your IRA is funded, has money, buys 100% of the initial units of a special purpose LLC, not like the kind you would open to run a business. It's not that kind of LLC. It's special purpose, and usually a single member LLC is typically passed through. Matt can back me up on that, but a pass-through entity where it's disregarded for tax purposes. Most of these single member LLCs are. So it's not that kind of an LLC, but everything you do within that IRA-owned LLC is just as though your IRA were doing it. All the same rules apply. So when your IRA has this IRA-owned LLC, it's not an active business.
And that's what's kind of cool about the self-directed, IRA LLC is, basically what's happening is your IRA is purchasing shares of the LLC, and the funds are placed inside the LLC with the purchase.
The IRA,
and then, the IRA funds are put into the LLC bank account. Now you have checkbook control. You can be the manager of that LLC, and you can cut checks, directly for investments. Now that doesn't mean that you're any better of an investor in that case. You need to be able to still do your due diligence, still do your homework on those deals, and realize that now when there's nobody to submit paperwork to in that case, to be able to say, hey, you didn't get that signature, this is not a right legal document here, which most custodians will put a kind of a stopping point and say, hey, make sure you get me all the documentation here. Now with you, you have complete control, so all the responsibility is on you in this case. It's still on you with the IRA custodian, but in some cases, it's like when you go to a really good private money lender and they find a bad deal for you. You find a deal and it's a bad deal, they'll tell you, we're not gonna fund this and you shouldn't flip this either. It's the same type of mentality. There's no real liability there. There's no, reason that they should, necessarily, there's no legality telling them that they have to tell you not to do this or anything like that, but sometimes the IRA custodian will say, no,
well,
stop
we don't want
here.
you to have a bad experience,
Yeah,
but we
yeah.
can't advise. So sometimes, like, if we see that if we can see that it's a bad deal, or we've done we just took a look, because as a business, do we want to custody this asset? That's the question we're asking ourselves.
Mm-hmm.
And if it's dangerous, and if it can lead to litigation, then that's not a good business decision.
Right.
So if we can see that maybe the person you're investing with was incarcerated, then we might say this asset's not administratively feasible, and they'll say, well, why? Well, we can't tell you the guy was in jail, because that could be slander, libel, or so forth. We can just say, well, it's an asset we choose not to custody. So that's not always what it means. But that could be one of the meanings of not administratively feasible.
There's some other intricacies and issues sometimes when you're dealing with different types of transactions as well. For example, joint ventures. I know we've had this.
We went through this.
We had this discussion already, right? Where basically a lot of times, and tell me if I'm wrong or not, where the stance typically or can be that, hey, who's going to sign and review this joint venture? Is it who's going to actually sign for this? Can you talk about the joint venture structure and why that's kind of like in the gray area or tough to get done sometimes?
Yeah. Well, a joint venture isn't something you can sell, so it's not an asset.
Okay.
So you're not going to buy someone's joint venture, right? So it's not an asset. And your IRA is for investment purposes only. Your IRA needs to invest in an asset. Well, a joint venture is not an asset. So there you go.
Okay, perfect. So, and I think that's important to understand. Question here.
Yeah, I read on Bigger Pockets that you're not able to use your IRA to invest in a property that you own, but you can invest in some. So I'm wondering.
When then puts it in your checking account, and then you put it in his C Corp, and then it comes back to you. I mean, there's a paper trail, the indirect. If you can't do it directly, you can't do it indirectly.
Yeah, I think that leads to a good topic, which is the prohibited transactions or the prohibited parties that you really can't do business with. Can you talk about that a little bit?
Yeah, pretty easily. It's lineal ascendants and descendants is the way it's written. And if you are a rule book kind of person, it's IRC, Internal Revenue Code 4975. It has all these prohibited transactions in there. That's where it's written. But it's your parents and grandparents and their spouses, you and your spouse, your children and your grandchildren are disallowed people. So your IRA doesn't do business directly with these people, but also a 50% business partner. And there can be other people that are disallowed, like anyone offering services to the plan. So if you had an IRA with us and I had a condo and you wanted your IRA to buy my condo, well, I would be offering services to the plan. So your IRA couldn't buy my condo. That's because I'm offering services, right? So like a realtor may be offering services or an attorney. So there are certain people that are disallowed besides just your family, ascendants and descendants. But the people who are allowed, it's not just, you can't say it's not family, because your brothers and sisters and your nieces and nephews and your uncles and aunts, they're fine. So your IRA could, for example, buy a house and your uncle could live there, but not your dad. Your IRA can make a loan to your niece to go to college, but not your own son or your daughter. That's a prohibited.
But you couldn't go through and give the loan to your niece to go to college and then have the uncle go through and give it to your kid to go to college. And you're getting some present benefit out of that possibly.
That's
so
true too, like
there's some gray
in-laws.
areas there.
Yeah, in-laws are a gray area too. What about your father-in-law? So then your IRA gives it makes a loan to your father-in-law for 20 grand, and then for Christmas you're driving a brand new car. So you gotta watch it. So you've got to be able to sit in front of an IRS auditor with a straight face and say, I received no personal benefit from this transaction.
Well, I don't know that that's the right example, given that we don't want to ever pay the IRS auditors anything. We could probably all sit in front of the IRS auditor and say, no, I didn't do anything wrong. What do you mean? So?
Well, they're probably coming to you because they see something. I'll tell you what, though, I've been doing this for 10 years, 11 years now, and I've only heard of a handful of audits where people are genuinely audited. and have a prohibited transactions. But a lot of times, people will get their accounts dispersed because they, what is it called? They take constructive use of their IRA. So they'll take, maybe their IRA has a rental property and they take the rent from the IRA, put it in their own like pocket. And then we had this one guy do this and he says, oh, but I'm writing off the rent on my income taxes. Yeah,
So anytime you touch the money,
Yeah.
you have problems unless you're borrowing from a 401k or something like that that is legit under that 401k plan.
Sure, right.
But a
401k 's
typical
you can't
IRA.
borrow from an IRA, but a 401k lets you borrow. I think he had a question, we'll get to you.
I was just gonna say, so you're more than an escrow company. You're
Well, we're not
actually-
an escrow company.
Right,
Yeah,
you're
yeah.
acting like an escrow company.
Correct.
It's not just the initial transaction. You're custodian
Yes.
the money and
They
giving
hold the
advice, not
Yes.
advice.
Yeah.
You don't give any tax advice, but,
We give you advice about your account. And, we were
Right.
talking about the solo.
because there's so many rules, they're way beyond me. I need someone to.
Right, and to talk to, well, we were talking about the IRA owned LLC, that brings up a really good point. I could tell you a little story. I was speaking at a Bruce Norris brunch, and I'd been, so a lot of people were there, and I'd been speaking earlier in the week to this couple, and he had an IRA owned LLC, and she had an IRA owned LLC, which is kind of the way to do it if you're husband and wife. Having separate LLCs is a nice way to do it for lots of reasons. And they had this perfect deal. They're so excited. They're telling me about Barstow. They've got this property, found this commercial property, and what they were going to do and how great it was. And we talked for an hour, and it's always at the end, because that's what I always want to hear about the deal. At the end of this hour-long conversation, they go, oh yeah, and we own the property next door. Well, it wasn't immediately obvious to them, but Matt's laughing, why that's a prohibited transaction. You're real estate investors, what do you think? Well, I'll tell you. If you own, you own this house, and somebody comes and buys the house next door and improves it or maybe pays more for it, what happens to the value of your property? Right, and you just got personal benefit from your IRA-owned asset. Even if they pay less, but maybe they put in a road, now you've got access, or they improve it and it benefits you personally, that's a prohibited transaction. So we had to chat about it. That was really a kind of a mind blower for them. But that's what happens when you've got the IRA-owned LLC is a tool, and you need to use it very, very wisely. Make sure you know what you're doing. It's no joke. And maybe when the regulators have a little more time to do these things, they're low-hanging fruit for auditors. And a couple of years ago, as you know, being a CPA, a couple of years ago, they changed the 5498, which is where we report account value, and they changed the 1099, where we report distributions, to include these boxes. So it used to be the IRS had no idea what kind of asset was in the account. Now IRA-owned LLCs, and see if they're performing correctly. You want to make sure yours is. So if you have an IRA-owned LLC, it doesn't mean we won't talk to you. Of course we will. Call us, like this couple, they had their IRA-owned LLCs. They came and talked to me. Hey, what do you think? And I said, well, I think it sounds prohibited to me, but here's the phone number for a couple of attorneys where you can discuss it with them. But it, since we don't give legal advice. But if you get personal benefit, it's disallowed.
Can non-prohibited parties from each other, can their IRAs do business together?
Sure. So like you and your uncle want to go and buy a house together. So your uncle is using his cash and you're using your IRA. Absolutely, all day long.
What about you and your parents' IRAs?
Yeah, actually you can, and there's a loophole. As long as you don't own that asset or have any ownership interest in it to begin with, if you fund concurrently, so if you both are on title when it records at the same time, you can invest or note, you and the other person records on title at the same time, then yeah, you can do that.
And typically in that kind of a situation, does it matter when if you have two IRAs for prohibited parties that normally can't do business together, but in these two IRAs they're funding at the same time, are they in any instance getting present benefit even from each other if, say,
And kind of fleshes that out, but it's I just wouldn't go there. I mean, you can invest in so many other things.
Right.
Right, and why not sleep at night and not have to worry about that kind of
Right,
thing?
right. And also we talked about, even if it's just a non-disqualified party, you might have a closely held business partner or something like that you do a lot of business with.
Right.
Or, it's more substance over form, right? So, I mean, if someone is, looks like they're, getting present benefit, you have to explain it to the IRS auditor in that case. And so you better have a strong case so that your entire, retirement account doesn't get cashed out for you and taxed. So.
And again, a lot of people don't get audited real quick, and so it's not like self-directed IRAs are getting audited every 5 seconds. That's not happening. but you want to sleep at night and you want to do it correctly and you want to follow the rules because this is precious money. If you can only put away $5,500 a year into a traditional or a Roth, or even if you're putting $5,500 away in a SEP, or $55,000 away in a SEP, I mean, it's precious money because it's capped, and
It was about investing at the same time, partially from your IRA and partially from your own.
no.
So it is allowed, but you don't recommend it?
Well, because how do you prove that you didn't have personal benefit? Yes, there's this ruling called, again, 2000-10, which you can, but I wouldn't, you want to talk to a lawyer about doing that. I just wouldn't go there. I mean, why would you take that risk? You have to ask yourself the question. So,
Yeah.
Yeah. Yes.
I have a question. So what about on the back end? Let's say that you bought a house in your self-directed account
Okay.
at $200,000, and then you're 68 years old, and the house worth 600. Like, what happens at that point? Do you
Love it.
want to go to sell? Like, what does that look like?
Sure. Well, when your IRA purchases an asset, it's supposed to not be for present or future use. So you're not supposed to have it in mind as a retirement home for later. And how do you prove that? Just keep a journal. Like acquisition date, costs. Here's a copy of the ad from advertising it as a rental, and you can demonstrate your intent to keep it as a rental or as all these years. And then now you're 68 and you decide, hey, I want to live in this house. So what you do is you can't buy it from your IRA because you're disallowed, but you go get an appraisal and you withdraw the house from your IRA at its market value, and you get 1099 for that. So you would pay income tax, just like if it was cash and you took that much cash out of your IRA, you get a 1099 and no tax. Same thing if you do the appraisal and take out a non-cash asset.
And that's why it's really important when you're doing these things to make sure you do the high yielding deals instead of a Roth 401k or Roth IRA or something like that, so that those big taxes don't hit you on the back end. So question here.
My question about the entity. So the Roth IRA we talking about, we follow the Form 990T. Is that what the federal income tax return?
990T.
A 990T is the tax return that you file when you're a tax deferred, like a tax-free entity. So the IRA would file a 990T if it owes UBIT or UDFI tax. That's like you and I file a 1040. Your IRA would file a 990T if it owed tax.
Okay.
And that tax would be the UBIT or the UDFI taxes.
So that form would have Schedule E follow, and the Schedule E would be like all the K1.
You're a
that you
CPA,
have
right?
there.
Yeah.
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 So I'm looking, the thing here is when you have the retirement fund, and in this situation, you investing either in active activity or passive.
Right.
So my understanding here, if you have a passive, like you collect rental income, you do a LLC entity, and then if you inactive, you do the S corp. So the S corp and the LLC ticking the box, C corp or partnership. So the rule could be different for each entity. So my question here is when we do the 990T, you have Schedule E and other K1 flow through, because I assume that you investing in the properties, so you select the entity different for whatever the property that you invested. So that's the reason why the taxation for the property is different, because the entities are different.
So remember that all the entities you are going to invest in or invest through are flow-through entities to the IRA in itself, and so that IRA in itself is not taxed unless you have to do the 990T for the actual IRA, in which case you'll be taxed on the debt financed income tax or the unrelated business income tax on the 990T, but it's completely separate. There's no Schedule E or anything like that. This just goes directly to your IRA. So your IRA and you are completely separate entities, and you're that basically an LLC or an S corp or whatever entity you have the rental income in or whatever investment, it flows right back through to your IRA, and you are completely separated from that on the tax side. That is a completely separate tax return from that perspective. So you don't have those types of issues with that aspect, because it flows right through. Now, if you have an S corp or a C corp for some reason, it'll get taxed at that level, and then the distributions.
You see what happens when CPAs talk to each other?
So, yeah, sorry.
Everybody else
Yeah.
We can explain it. I can explain it in more detail. So.
And if the moon is full on a Thursday, then it's something.
So, yes, it's all entities and all the fun stuff. So, let's let's talk about some of the tax benefits associated with this, because I think you know, you said the $5,500, you know, into a traditional IRA, you know, and it doesn't sound like a lot, right? I mean, it's not, doesn't really do a whole lot for you. It gets you some tax benefit associated with the traditional IRA contribution. But where I see the real power is a self-directed 401k. So most of the time when you think of it is the $5,500. If you start a flip business and you're starting to really do well and you want to reduce your taxes, you got to look at these structures, and you have to look at the 401k structures for the self-directed.
You do, and let's back up a little bit. I mean, most of us know what a 401k is because we've all had a job, and you know, there are 401ks with your employer. So when you work for someone else, you have one role, employee, and that's one role. And like Matt was saying, if you're under 50, your contribution this year is $18,000 you can put in there, you can max out. And if you're 50 plus, it's 24. Actually, it's 24,500 now. It's 18,500, 24,500. If you're 50 plus, so there's more. It's a catch-up contribution. That's if you're an employee. But if it's a solo 401k, that means, and you have one, it means that you're self-employed. You have no full-time employees in any of the companies you own. So that's the litmus test to get. That's what you have to pass through to get one of these accounts. So you're self-employed, no full-time employees in any of the companies you own. Now you can do what Matt did, make your employee contribution, which he contributed $18,000, and then make your employer contribution. As Matt said, it was 25% of his income, and it equals 15 grand. So you had, you know, $33,000 contribution. And so knowing some of that was Roth, but you probably got a tax deduction on the other part. The employee bucket can be Roth, but the employer bucket is always pre-tax. So if you're self-employed, you're wearing two hats. When you said you have a solo 401k, so you're wearing more than two hats too, because when you have a solo 401k, you're the employer, and so you're responsible for the plan and the plan document. You're the employee, so you're a participant, but you're also the trustee of the plan. So it's with IRAs, we custody them, we do the tax reporting and record keeping, but 401ks are different. And this may be why you're not pleased with your current servicer, because they're not servicing your account. You are. I mean, you're the trustee of the plan, and so you're responsible for the tax filings. We still review the accounts. We custody the funds. We do the record keeping on the funds, but then you're the trustee of the plan. You and your CPA are filing, and if you make more than $250,000, if you file a 5,500 easy, I think, or something, and so the filings that you have to file. So you and your CPA work together, and you do those filings when it's a solo 401k.
And how do you? I know you've dealt with this before with other people. How do you go at the end of the year know that you have to file your 550 EZ and know you're above that if you own real estate in your account? So you may be under the 250, but then your value of the properties now might be higher or something. What's the process look like when you're trying to value your account on an annual basis?
For me, that process is so simple. I pick up the phone and call my CPA. Done.
Nice.
But yeah, that's what they do. I mean, then they give you tax advice. Have an alternative asset. Well, you're not really sure what it's worth. What about a note? If someone's going to evaluate a note, they're going to look at the face amount. They're going to look at how many payments are yet to be received, and then maybe give you a little discount for the marketability of that note and give you a different value. So these values can be subjective. So the way it seems to work right now is that if you've got a taxable event, like you're going to do a Roth conversion, or you're going to do a withdrawal, and you're going to get taxed on it, you need a full-on appraisal of that asset. So we know evaluators that'll evaluate hard to value assets that are in IRAs, self-directed IRAs, like notes. And like precious metals are easy too, because there's a spot price, right? So you know what that is. You know what that silver is $13.46 today or something like this, and you know that. So you know the value without really getting evaluated. But yeah, so when it's every year, we're going to ask you for the value of your property or the value of your assets, and then we'll have you tell us the value of your assets, and we're going to report that value on your 5498. But say, for example, you've got an asset, and then you want to tell, and we say it's $100,000 on the books, and you email us and you say, oh no, that asset is worthless, just write it off. We can't do that because we're not valuators. We need proof that it's a zero value asset. So you need to have a valuation, because we can't write down a value without a third party evaluator approving it. That goes back to another part, by the way. is how incredibly important it is to do your due diligence before you invest. I'm just going to tell a story because stories are good.
Please.
There's a real estate investor club near us that ran for 10 plus years, and they were having people invest in notes. And it turns out that they were, since they've been not sentenced but convicted.
They're criminals.
Okay, hashtag criminals. You know, who knew? Certainly not their investors, but since that happened and their assets are worthless, they were calling us. We had 17 accounts involved in this, saying, well, you know this happened, just write it down to a zero value. It's like, well, you know, we'd like to, but we can't. So a couple of reasons for that, because we're not valuators, but also a lot of times there'll be some value that comes back. So say, for example, you invested in a private placement and that company went bankrupt and then there's zero value. You can see the bankruptcy papers, but they were able to retrieve some value. We've seen people get 80% of their value back, and that can happen too, but you just closed your account. Where does it go? And that creates a problem. It needs to go back in the IRA, but then you don't have an IRA anymore. You just closed it out, wrote down the value to zero. It's going to be taxable to you. So it's kind of going deep on a lot of
things. I think it's important to understand, you know, this stuff because, you know, there's so many ways that, you know, you could do the wrong thing. You know, you could mess up, and you could go through and do the wrong due diligence on an investment. You could go and do a prohibited party transaction, you know, and have a big chunk of your IRA, if not all of it, taxable then. You know, there's issues with it that you just need to be educated, but at the same time, if you're educated about it, it can be one of the best tools you can use.
And we don't usually, I'm telling you like these things to watch out for. We're telling you about all the exceptions. The rule is that things go just fine. I mean, most of the time. We don't usually see fraud. We don't usually, in fact, like coming back from the conference, everyone was unanimous in saying, yes, we're seeing less.
To keep that knowledge base up when it comes to whatever you're investing in, whether it's syndications, you know, understanding, are they leveraging, are they not leveraging, what are the rules in those syndication documents, if it's a property, making sure you understand all the property aspects and know what it's going to cost you. On the notes, making sure you understand the paperwork and who you're lending to and what the collateral piece is. It's doing those specific things, that will solve 90% of your problems right there, just doing the right homework on your assets and the investments that you're investing in. And if you don't know, if you're not sure about this type of thing, there's plenty of advisors that can actually go do this for you and can actually go through and show you and teach you, this is how you do the due diligence on an investment.
Didn't the gentleman in the back say he was done spending money learning?
Yeah, there you go. I mean,
you know, so you spend $20 and you come to a FIBI meeting and you learn so much. It's not just from Matt or me, but it's from the people in the room, because everybody's got a story to tell, and everybody, you know, has got an experience that they can share with you about how they did something. And say, hey, I'm thinking about doing this. Have you ever done this? When you're networking, yeah, I did that. Well, you know, what do you look for? And people can help you. This is such an amazing community we have, really all over the country. But I know this, you know, since I'm here in Southern California, so what a community! Like you Facebook friend everybody, and then you've got a property in Long Beach that you're working on, and suddenly you need a plumber. You're like, Facebook. I need a plumber in Long Beach. Who knows what, you know, somebody, and then there's a community of people. Or you call Matt, hey Matt, you know, a plumber in Long Beach, and they'll help you find some. You know, you need it. It takes a tribe here, I believe, with investing. But you get great advice from being in place.
Hey, that's what's great about these meetings is like I meet new people with resources and stuff all the time. That's why we do this. That's why, you know, I'm here every month since 2008, just meeting people, and it's been cool. You know, everybody that I do business with, or 90% of them, I've met at these different groups, and the power of networking is huge. You know, when I first got started, I was going to 4 networking events a week, every week, to go raise capital and invest and find investors and find resources and different, you know, service providers and things like that could help you in your business. And you know, some people have properties, some people have money, some people have, you know, resources and tools and things like that, and time. Some people have time. That's one of the most important things in the world. So.
Well, when you've got a self-directed IRA investment and you want to talk about it, that's when you call us. Hey, there's this deal and it looks pretty good, and so we want to talk to you about it. Well, tell us about the deal. You know, what are you doing? Who are the parties involved? You know, what does it look like? And say, for example, it's like, well, I'm going to make this note to my uncle at 1%. It's like, okay, well, 1%. You know, your IRA needs to be an investment. That's something. Are you going to get personal benefit? So if you want to know what does this look like in a self-directed IRA, we want to have that conversation with you. And we do that every day. People come up with, like you, with the most creative ideas, you know, like oh, because you know you can do things with your own money. Just like when you talk about like notes, I can just picture like Jack Shea. Anybody know Jack Shea? He's kind of one of the older gurus. He's a great guy. He's the guy. He'll be in the bar, napkin note. Okay, boom, done. Let's go do this. And that's fine with your money, but when it's self-directed IRA money,
it needs to be done right. And we talked about the present benefit that someone else, that you get from your IRA, but there's also the other way where your IRA can get present benefit from you. Like, for example, you know,
right.
Doing labor. Like, can you talk about that a little bit?
Of sweat equity, right. So you're not allowed to swing the hammers. You're not allowed to mow the lawn in your IRA-owned house. Yeah, and you paint the walls. Just keep it arm's length. All that. And so here's an example of you're not allowed to provide goods, services, or facilities to the plan. That's what it says. So we saw somebody who IRA was buying a house here in California. So it's got the car form. What is this, like an encyclopedia now? It's just like so thick. So we're going through it, right? And we're going through it and looking at it, and it's like the title correctly, looks good. Finally get to the back page, and we see, guess who the broker of record is? It's his dad. So so his dad is a disallowed person offering the service of being the broker, the selling broker, offering this service to the plan. He can't do that, but not only did the dad want to offer the service for free, which is disallowed, he wanted a commission too. That would be a disallowed person getting personal benefit. So 2 strikes against that deal. They had to rewrite the deal so that there wasn't a disallowed person offering services to the plan.
And that's key, especially for rental properties too. Like, I own a management company. I can't have my management company manage my properties. I have to have an outside management company do that. And so it's the same type of thing. Like, I would be, just because I own the company, I would be providing personal services to my own IRA if it's managing that asset and getting a fee for doing that. So I have to have an outside company doing that piece. It's really interesting when that happens. And so, but I'm going to switch gears real quick, and I want to talk about custodians and trust companies.
Okay.
Can you tell me what specifically the custodian does in a self-directed IRA, and specifically what the administrator does in a self-directed IRA?
This is an interesting question, and I mentioned I'm on the board of directors at RITA, and so I represent the administrators. But the truth of it is, if you have a self-directed IRA, whether you go through a facilitator, an administrator, or directly to a custodian, you're getting the same deal. You're always going through a custodian, always. There's always a custodian on the back end of the deal. So a custodian, with an administrator or a facilitator, you've got somebody that their only job is customer service, is helping you with your self-directed IRA. That's their job. That's our job. That's what we do. But with the custodian, they've got additional responsibilities. For example, cash management duties. That would include things like getting audited, doing internal audits, external audits, cash management, making sure that they're investing the idle cash correctly, regulatory, audits, things like that. So their attention is divided. One arm of customer service doing all this, but then their attention is diverted over here to running the business of running a trust company, which involves all these other intricate things. Maybe even there could be litigation and things like this that they're involved in. So a trust company or a custodian bank could be a custodian as well. Their attention is going to be divided. So with an administrator or facilitator, you're dealing with somebody there just to offer you customer service.
And I think that's really, really important, because on the administrator side, the services are all across the board, and the quality is all across the board from what I've seen. There's the real big ones out there like Intrust and Equity Trust that I think are decent companies. They have a different fee structure. They have different administrative structures, and you have to be careful about the big companies and getting lost in the shuffle and things like that. One of the things I like about UDirect is the fact that there's a low admin fee, and their administrative function is top quality. They have the right people on the ground there that can actually come in and move that investment through. Because if you're trying to close on a house really quickly, or an investment very quickly, which is usually what happens on really good deals, you need someone that is reliable on that back end, that isn't going to take a long period of time to get that thing funded. And a lot of times there's totally different fee structures where it can be on asset value, it can be on how many assets you have in that account versus like a flat fee. And some of those other bigger accounts, the higher your value goes, the higher the cost can go as well. It's a sliding scale up, and that's a big negative in my eyes. When you're like, why am I getting penalized to have more money with you? it's kind of interesting. So can you talk about some of the differences and some of the different fees that are happen inside of a normal IRA?
Sure, we've got a whole comparison of all of the self-directed IRA companies and their different fee structures. And you're right, some will charge you a flat fee, but then if it's real estate, it's so much per year on top of that they have that, or it could be the more your account's worth, the more that you pay. But ours is a flat fee, regardless of the number of assets and regardless of their value. So most everybody has a setup fee to open the account. Ours is $50. That's an industry standard. $275 a year is our annual fee. And then we ask that you leave $325 in the account. I have some brochures if you want to see for yourself or take that home in writing. We've got that. But that's what we charge. So, and I think what's great about my company, what makes us different is my background's real estate. Like I mentioned, property management. I was a realtor. I was in mortgage loan servicing, mortgage loan origination. So I understand deals. I understand how they need to be done and quickly. And a lot of times, like for example, today there was a question about a deal, and it was my background in mortgage that was able to be the log breaker or the log jam breaker here for this deal and get it moving forward. Because it's like, no, if you're doing this, you do it like this, And those are the people that I hire, people with mortgage and real estate experience, so that they understand what you're doing. Because 95% of the assets we see are real estate related.
And I think it's important to have really good custodians and administrators. I mean, there's been companies that I won't name names. The previous companies are no longer in business, but they went through and they commingled funds, and they got in trouble doing that, and they had problems with that, and they went, I don't know if they went to jail or not. I can't remember if they did or not.
I know they got convicted,
okay.
They had, and then they did something else stupid on top of that. So
yeah. So I mean, there's and in the beginning, it seemed like, I mean, it's been around for 30 years, but it seemed like some of these custodians were just starting up and things like that. And
well, let's talk about that a little bit, because you want to know that your funds are safe, and we put that out on there. So this company that he's talking about, that'll go nameless, was what's called a delegated administrator. So we're an administrator. We title the assets in the name of our custodian. So it's not you direct for the benefit of your IRA. It's our custodian for the benefit of your IRA. We're not we're an administrator. We don't let you do this. So that was a delegated, and so all the money came to the administrator. We don't handle your money. Only the regulated and licensed trust company handles the money with us. With us, the people that handle your money are bonded and insured against theft and fraud. But that company that got into trouble, they were like an unregulated trust company being delegated the way they were. And so there have been a couple of examples of that delegated trust company situation being abused. Okay. And so it's phasing out in our industry as gradually more and more. That's very, at RITA we frown on that structure.
Okay.
So it's phasing out.
And you mentioned you just got back from Washington at this update meeting. Yeah. And I'd love to understand, what are some of the things you see coming down the pike with the industry? What are some of the changes you see happening, some regulatory changes or anything like that? Do you see any major issues on the horizon?
A couple of things. One of the things we were concerned about for a long time was the Department of Labor's fiduciary rule. And that was a big thing where they were changing the rules, but then they decided that it's because we're not giving advice, we're not fiduciaries, but those were all Democrats, and then Trump came into office, and boom, now it's kind of off the table. It's for the most part off the table, but then the House might flip, and then it might come back. So we never know. We just have to watch the bouncing ball, see where it goes. But I'd say probably the hottest topic right now is cryptocurrency. Anybody curious about cryptocurrency? Right? How many of you have a crypto wallet, like Coinbase or what's the other one, Kraken or something like that, right? So have you watched that documentary on Netflix, a Bitcoin documentary? Because it showed up on Netflix one day, and I watched it, and then I watched it again. I've never done that. Like immediately, I need to know this. Such a good documentary. It talks about what is Bitcoin, what is blockchain technology, who started this. They kind of don't know. The person's kind of a secret person, and where's it going? What is it? It's early days with this cryptocurrency. So can your IRA invest in cryptocurrency? The answer is yes. So at the conference, it was so interesting. At this point, all these trust companies, we're friendly with one another. At first, everybody kept their cards close to the chest, until we realized we all have the exact same problem, and it's not a competitive issue. So with cryptocurrency, you can have a device called cold storage, and you can custody cryptocurrency as a custodian. But there are so many things that are these passwords and like a whole bunch of a chain, I think it's called a seed, a whole chain of words that it belongs to you, and then another chain of numbers that belongs to you. If they get one digit off, your cryptocurrency could be lost forever. So the consensus was that the risk for a self-directed IRA custodian to custody cryptocurrency personally was too great as a company to take on that risk. And who would insure it? No one.
Yeah, because you can have it on a hard drive, basically, right? A secondary hard drive.
Right, that's correct. That's a cold storage. And in fact, one of the guys said that he had one. He went ahead and bought one because he thought, this is the new thing. He wanted to be up on top of things. And he said, I can't do this. I wouldn't sleep at night. What if something was one? We're human beings. We make mistakes. There's one guy that had one of these cold storage units, and he realizes it has $800 million in cryptocurrency on it, and he's digging up a dump looking for this because it's so valuable. How'd you like that to be used? So there's a lot of risk, and it's early days on what this is. So what we say and what the industry is saying is that have your IRA invest in IRA on LLC. The LLC opens the wallet. You as the manager would open the wallet in the name of the LLC, the IRA-owned LLC, and then you're making those decisions. So if there's a mistake, you've made it, because we don't want to be the ones making that mistake because we typed a 2 instead of a 3, or something like that.
It's a big risk. And,
right.
And I think there's going to be a lot of changes with new investments and technology that comes out and things like that. I mean, things are changing so drastically right now. It's going to be a difficult thing in the industry to say, how do we, what's our liability as a custodian and an administrator to handle these things?
At fraud, you're right. And so a couple of years ago, or actually for the last several years, maybe 5 years, the big thing is, crowdfunding, and what's this? It's a portal and the Jobs Act. And so we had this regulatory panel. There's somebody from the SEC, FINRA, NASA, and the FBI on this panel. I mean, like, very people with a lot of responsibility. And they're telling us, they start talking about crowdfunding, and they called it quaint. That it wasn't what we thought it was going to be. It's a disappointment. It just didn't come out like we thought. But when they use the word quaint to describe crowdfunding, what crowdfunding really is not new. It started a long time ago when they came up with the Reg D offering. What is it? Howey test? Was it in Orange County with orange trees or something? It started like, what is a syndication and all this. So if you're raising other people's money, you go to your attorney and you can file a Reg A, B, C, or D offering. A, B, C, and D have different rules on how you can advertise, how much money you can collect, and so forth. But if you're going to gather other people's money, that's what you're using. And really, crowdfunding is just using one of these vehicles through a portal. Now, notes also can be a security. So that's another thing too. Just to throw this out there, we were talking about the regulatory panel. That with notes, you want to see that is it a security? Is this note a security? If it is the note offer registered with the SEC, and is the deal registered with the SEC? Part of your due diligence when you're looking at these things. So again, this is when you want to dig deep and do your research.
Okay, thank you. And anything else you can think of that's happening right now? I know it's a tough one because it's interesting to me.
It's never that dramatic, which is great. And right now, there's so many other things going on in Washington. Like I think they're hiring new people every day, is what I read, right? Because everybody keeps changing jobs. So they're not really focused on IRAs intensely right now. It's funny how we know that Trump likes to tweet. Well, one of the most powerful things he ever did was tweet from our industry, and he said, "Look, we're leaving your 401k alone." When they were coming up with the new tax laws, because there was something we were afraid of, something called Rothification, that everything was going to have to be a Roth, and there was some threat about this. And then Trump said, "Look, it works. This was a tweet. It works. We're leaving it alone." Our great local resources for in fact, their company's crowdfunding lawyers. I think that's their website. So we've got a lot of, and I'm sure you know them. You'll see them at clubs. You'll see if you want to hear them speak, you can learn more about that. But you've got so many resources for this sort of thing. If you want to raise capital, and which I'd like to talk about for a second too, raising capital. So self-directed IRAs, it's not just for your retirement, because man, we all need to save for retirement like crazy. Retirement's coming at you like a freight train. Do you have like a niece or a nephew? Like her niece is 13 and her niece was just born. Yeah. And she's 13. How did that happen? Well, that's how you're going to feel about your retirement. So whatever you do, I mean, when you leave tonight, just go do yourself a favor, make a contribution to some retirement account. Just do it for yourself. Pay yourself, not the IRS. Number one, save some money. And then if you're going to invest it, do your due diligence. That's incredibly important. Get the advice of experts. incredibly important. But what's happening on the, on the national level, we're looking at state laws, and there's a state law in Ohio that we're looking at. And so Rita acts as a lobbyist when laws are about to be enacted that can affect our industry. We just wrote a paper to the state of Ohio. They're about to make this decision. Hey, consider these things before you make your decision. And so we work as a lobby to, because people don't understand self-directed IRAs, and they make rules. We wouldn't even, I don't think we'd be in industry if it wasn't for this Rita group.
But I thought all politicians are extremely intelligent about tax law and stuff
Correct.
like that.
Correct. All
So-
politicians.
So,
Are
okay,
experts.
this is awesome information. So if someone wants to learn a little bit more about self-directed IRAs, where can they start? Can they go to your website and read about it? Can they find different information about this?
Tremendous amount of information on our website. You can email me. I can send you links to some videos. I have a video with 57,000 hits. Just covers the basics. How to open an account, and it just really goes through the basics. I'd be happy to send you that information. But if you've got a specific deal you want to talk about, just call us. I've got a staff, and we'd be happy to talk to you about your specific deal. So
Yeah,
if anybody has a question.
we help with that as well quite a bit.
Yeah.
If you guys need help with just the general understanding of that, I help clients do that all the time. I don't charge for that kind of stuff. So if you have a basic question or just need some help, let me know what's up, and I'll help you guys out. Question over here, sir.
Well, I actually have two questions. One is self-directed IRA versus 401ks.
Okay.
And second one is having either one of those invest in PPM. Because what our company does is we invest in properties as a group.
Yeah.
And we put out PPM.
So your first question is, do I want an IRA or do I want a solo 401k? So what you want to do is, before you self-direct, develop a plan. What are you going to do? What's your plan? And you develop that plan with your advisors, with your real estate advisors, your tax advisors. How much do you make? Maybe you make 60,000, maybe you make 600,000, maybe you make 60 million. I don't know, but you've got a tax structure, right? And so what fits your tax structure? So that's how you decide, do I want to, or maybe are you self-employed or are you an employee? Are you retired or what are you doing? Because in order to contribute, you have to have active income to contribute to a plan. So there are a lot of different things. So you start with your plan. What do you want to do? And everything is based on that plan. Like, how do you execute your plan?
It's not so much for us as it is for, we're trying to get this information back to other potential investors.
Right. Well, you're not going to give them tax advice either.
Right, no, I
Right.
just want to let them
Yeah.
find out if they were to have one,
Yeah.
how would that work investing in our PPM?
Well, so here's the takeaway. This is a takeaway from tonight, something to write down. If you are raising capital, this is a question to ask. Do you have an IRA or do you have a 401k with a previous employer? If they say yes, you'll be the hero, because they won't even know that money could be invested in your deal. They won't even know that. And you'll tell them, they'll say, no, an IRA can only invest in the stock market. What are you talking about? An IRA can't buy a house. We have CPAs tell their clients an IRA can't buy a house, but they kind of can. So if you just say, yeah, I know, do you have an IRA or do you have a 401k with a previous employer? The answer is yes, they can invest in your deal. So you're not, so an advisor can tell you what you should or shouldn't do, but if you're not an advisor, then you can tell them what's allowable.
They're separated from their employers.
They can roll over.
Right,
Their
they're
own
separate.
plan.
But
Yeah.
if they're currently employed, they can't utilize that.
That's a great point. That's an excellent point. So if you're presently employed and you're thinking, wow, the self-directed IRA thing sounds really great. And by the way, it's not, we just say IRA because it's a blanket statement, but it's a traditional, a Roth, a SEP, a simple, a spousal, an inherited IRA, a solo 401k. It can be an ESA or an HSA. All those things can be self-directed. And now what was I saying?
If you
I didn't get it out.
Currently employed.
Okay.
I think it's important definitely to understand the structure first, because in reality, you can have all of them. It's really cool when you start doing the tax strategy stuff and you start saving money,
Yeah.
It's,
But if you've got, so maybe somebody wants to invest with you and they say, oh my God, that's great because I'm working at Boeing and I have this $500,000 in my 401k, I want to invest with you. Well, what you want to tell them to do is this. You just tell them no, because it's not always no. What they want to do is go to their plan administrator and ask for what's called an in-service transfer, because they're still working there, they're in service, but they might be eligible for an in-service transfer. Sometimes you can get one if you're over 59 and a half, or maybe you worked at company A and it was bought by company B, and the money that you saved at company A can be transferred in while you're still in service. So there can be exceptions. And it's not a law or a rule, it's a contractual thing in your plan, in the company's plan document, that's where that's written.
And you want to read the plan document and not rely on your HR person to tell you, because most of the HR people don't understand this at all.
If you're Matt Owens, you read the plan document?
Yeah.
Or you can quit your job.
Yeah, you can quit your job too, yeah.
Then I get to-
Like you back here, you can quit your job.
Then I get to explain it to my wife and let her fall asleep. She actually told me the other day, I'm really interested when you talk about real estate, but for some reason I just want to fall asleep. I'm like, oh, great.
Well, it's detail
My wife,
oriented, unless
yeah.
if you're in the moment, but if you're thinking about, hey, look, I've got this plan, so start with a plan, and how do I get from point A to point B? These are fascinating facts, because it's going to move you further down the ladder to achieving your goal. But if you don't have a goal, then it doesn't apply to you. So have goals and have plans.
And that's really important. I mean, really, with that goal in mind, most financial planners will say, build your retirement to here so that it'll last you until you die, and then you die broke. That's been the mentality, right? It's like keep building and building, because they can't create a cash flow stream that's big enough for you to retire off of. Those assets that typically you invest in, unless it's way up here, are not going to produce that kind of cash flow. And so, it's interesting when you start to learn these strategies. The reason my learning is like always, trying to learn as much as I can, is I know financial education is the key to financial freedom. And so if you can actually do that and build your retirement account to where it produces enough cash flow to where you're using that to retire and never depleting the principal, and having more coming out or coming in so you can reinvest that money to keep up with inflation on top of that, you are truly financially free at that point. And that's really the goal. That's what got me quitting my CPA firm job to go into real estate full time and learn this stuff. It's because you realize, stop trading your time for your money. What are you all here working for? You want to work towards building assets that create the income without you having to work for it long term.
And every
right?
one of these little facts is like a building block toward that goal.
Right, and that's huge. I mean, when you start to learn, like if you're making $200,000-$300,000 a year and you start saving $50,000-$60,000 in tax a year from proper tax planning, you're going, whoa, that is a big deal, and that
Really
is
powerful.
compounding your growth at that point. So, absolutely important. So, everybody, give Karin a round of applause. Can you give them your website one more time?
Say again?
Can you give them your website one more
Sure,
time?
it's the letter U, udirectira.com. If you want to email us, it's info@udirectira.com, and we're happy to talk to you or email with you, whatever, and answer all your questions. So.
Perfect.